Hi class, welcome to chapter 10. We're down the balance sheet to the stockholders equity section. Hopefully you'll have a easier week with this chapter. Just pay attention to the details that I'm going to cover in these examples. The first example is brief exercise 10-4 from your textbook. It talks about a company that issues 1,000 shares of $1 par value common stock at $30 a share. We're asked to record the issuance of the stock. And you can read in your textbook about par value. But par value, and they don't mention this in the textbook, but par value is kind of an archaic concept. But nonetheless, we still sort of use it. Par value is set up when you create your company. Okay, so how do we enter this? The thing that you need to remember is the cash that they get is the cash that they get. They got $30 a share. So 1,000 shares at $30 a share. So 1,000 times $30 is $30,000. The only amount that gets posted to the common stock account is the par value. So that's 1,000 shares times $1 par value. The difference goes to this account called additional paid in capital. And I'm going to abbreviate it for obvious reasons. APIC, additional paid in capital. So that's the difference, 29,000. How would that entry differ if they issued no par value stock, which is pretty common? Well, in that case, we would just do what we've always done. We would debit cash for the 30,000. Oops, not 300,000. And we would credit common stock for the 30,000. Pretty simple. If you forget this, though, it can cause a lot of problems with your entries. Okay, the next one, brief exercise 10-5. So this company issues 1,000 shares of its 1 cent par value preferred stock for cash at $32 a share. Same concept, except it's preferred stock, not common stock. So the cash they receive is what they issued it for. So 1,000 shares times $32. The amount that goes to the preferred stock account is only the par value. So that's 1,000 shares times 1 cent, or $10. The difference goes to the additional paid in capital. And in real life, we have an additional paid in capital probably for preferred stock and one for common stock so that we can keep track of that. So that's the difference, the 32,000 minus the $10, or $31,990. Brief exercise 10-7. So Rachel Designs has 2,000 shares of 7% $50 par value cumulative preferred stock. So that's a type of preferred stock issued at the beginning of 2019. All the remaining shares are common stock. Due to cash flow difficulties, the company was not able to pay dividends in 2019 or 2020. They plan to pay a total of dividends in 2021 of $23,000. So since the preferred stock is cumulative, that means that they always get paid their dividend even if it's late. So we have to calculate preferred dividends in arrears. And we'll do that calculation, and then we'll know how much of the total dividends goes to preferred and how much goes to common. So first we have to figure out the preferred dividends in arrears. Whoops. do that over here. If I could spell, and we'll do it for 2019 first, because if they're not paying until 2021, they have preferred stock that has dividends due for 2019 and 2020, because they were not able to pay dividends in 2019 or 2020. So what we'll do here is we calculate how much dividends they should have received in 2019. If it's 2,000 shares and it's 7%, so 2,000 times 7% times $50. That's how we calculate preferred stock dividends. So $7,000 for 2019. And then we'll do preferred dividends in arrears for 2020, which would be the same amount, 7,000. Then we need to calculate the preferred dividends for 2021, because they're going to pay dividends in 2021, and it's got to go to the preferred stock first. So that's a 7,000 amount. Okay. So now we have $21,000. So how much of the $23,000 dividend will be paid to preferred and how much will be paid to common? Well, we know that 21,000 goes to preferred, so common stock dividends would be the difference of $2,000 for a total of $23,000. This is the hardest part for students typically. You take the shares times the percent times the par value for preferred. You only do that for preferred. You do not do that for common. Okay. Now we want to talk about the purchase and resale of treasury stock. Treasury stock, and you can read about this in your textbook as well. Treasury stock are shares of the company that are on the open market that the company repurchased. There's many different reasons for repurchasing, so you can also read about that in your textbook. So for BE 10-8, they're telling us that California Surf Clothing Company issues 1,000 shares of $1 par value common stock at $35 a share. Later in the year, they decide to purchase 100 shares off the market at a cost of $38 per share. We're asked to record the purchase of treasury stock. All we're going to do is debit an account called treasury stock. Treasury stock is a contra equity account. It carries a debit balance to increase it instead of a credit balance, because it reduces total stockholders' equity because it's not out there outstanding any longer. So we purchased 100 shares at $38 a share, so 100 times 38 is $3,800. And we probably had to pay cash, so we'll credit cash for $3,800. So in BE 10-9, when they resell 100 shares of treasury stock at $40 a share, we need to record that entry. So they're reissuing it. So they're getting cash, 100 times 40. But we need to remove those 100 shares from the treasury stock account. What's important to remember here is you can only take it out of treasury stock at the same rate you put it in treasury stock. So when we purchased it for $38 a share, so we can take it out at $38 a share. So 100 times 38 gives us 3,800. The difference, as you can probably guess, goes to additional paid-in capital. And that would be the difference between 4,000 and 3,800, or 200. The important thing to remember here is when you take the treasury stock out of the treasury stock account, you can only take it out at the rate you put it in, not the total amount, but the rate. In this case, the total amount is the same. But if you had reissued less shares, you could still only take it out at $38 a share because that's what you put it in at. Okay? Now let's do a whole set of transactions for the stockholders' equity section. So this company has two classes of stock authorized. And if I didn't mention this before, it's really important, and I put it in my tips, is to know the difference between authorized, issued, and outstanding. Once stock is issued, it never becomes unissued, and that's an important concept. And you'll see that in the last problem that I do. So they have two classes of stock, $10 par preferred and $1 par value common. At the beginning of the year, 125 shares of preferred stock and 3,000 shares of common stock have been issued. It's important to read these paragraphs and don't forget about this already issued stock. The following transactions were for 2021. And then it tells us some beginning balances, which we're not going to use right now. You're asked to record each one of these transactions. So on March 3rd, we issue an additional 3,000 shares of common stock for $10 a share. So we got some cash, 3,000 times $10, or $30,000. Remember, the only thing that comes out of the common stock account is par value. The par value on the common stock is $1. So 3,000 times 1. The difference goes to APIC, additional paid-in capital. Sorry, I can't seem to type today. And that would be the 30,000 minus the 3,000, or 27,000. April 1st, they issued 175 additional shares of preferred stock for $40 a share. So same thing down here. And I'm not sure why. Let's just fix this. Okay, sorry, my OCD got the better of me. It was a font issue. So what we're doing is on April 1st issuing the 175 shares of preferred stock for $40 a share. So cash. So we've got 175 times 40. Preferred stock. Par value. We've got 175 times the par value on the preferred, which was $10. And the difference goes to additional paid-in capital for $52.50, which is, sorry, the 7,000 minus the $17.50. June 1st, we declare a cash dividend on both common and preferred stock of 25 cents per share to all stockholders of record on June 15th. So that means that anybody that owns stock on June 15th, and you have to pick a date because stock is traded on the market, so you have to know who actually owned it when the dividends were declared. So June 1st, still got an issue with the tech. Well, we'll just live with it. So on June 1st, we issue dividends. We declare dividends. We don't actually issue them. So we're going to debit dividends, and we're going to credit dividends payable. Because we're not actually paying it yet, we've just declared it. When we declare it, it becomes a legal obligation. So the question is, it's 25 cents per share. How many shares do we actually have? We have to figure out how many shares we have. So let's just do that calculation off to the side. This is where we need to remember that we started with some shares. So we had 125, and we had 3,000, and then we issued an additional 3,000 and an additional 175. So we have 6,300 shares, and it is at a rate of 25 cents per share. So 6,300 times 0.25. That's the dividends. June 30th, we pay those dividends that we declared on June 1st. So we're going to debit dividends payable to reduce it, and credit cash for the $15.75. On August 1st, we purchased 175 shares of common treasury stock for $7 a share. So August 1st, we purchased treasury stock. So we're going to debit treasury stock because it's a contra equity account, and we're going to credit cash. And we purchased it 175 at $7 a share. 175 times 7. Debit and credit. October 1st, we resell 125 shares of the treasury stock purchased on August 1st. So we're reselling 125 of these, and we're reselling them for $9 a share. So this is an issue, a stock issue. So on October 1st, we're going to debit cash for the amount we received, which is 125 shares times $9. We have to take out of the treasury stock account at the same rate we put it in. So if you look back up here, we put it in at $7 a share, so we need to take it out at $7 a share. So 125 shares times 7 for $8.75. The difference goes to additional paid-in capital. And you can just take the difference between these, or you can say it's the difference in the what we purchased it for and what we sold it for. If we purchased it at 7 and sold it for 9, the difference is 2. So it would be 125 shares times 2. Or you could just take 1125 minus 875. Either way works. Okay, good. Now let's look at this. We've got a partial balance sheet for this company. And the thing that you want to notice on these is it says in thousands. That means add 3 zeros to every number to get the real number. This is very typical of companies when they present their balance sheets and their financials. And we're going to answer a series of questions here based on this section. And the thing to remember is authorized, issued, and outstanding. So keep that in mind. How many shares of preferred stock have been issued? Well, if we look at preferred stock, we can see that 0 have been issued. So 0 shares have been issued. How many shares of common stock have been issued? Well, we have 20,000 plus 3 zeros in here at $5 par value. Remember, only par value goes in here, so we can actually take the total dollar amount and divide it by the par value and come up with the number of shares. And remember, add 3 zeros. So 20,000 plus 3 zeros divided by 5 gives us 4 million shares have been issued. Total paid in capital, which includes preferred stock, common stock, and additional paid in capital, so it includes all of it, is 120 million. That's 120,000 plus 3 zeros. At what average price per share were the common shares issued? This is a fairly simple calculation because we don't have any preferred stock. If we had preferred stock, we'd have to remove the preferred stock from the total to determine. But since we don't have any preferred stock, we can say that the 120 million includes only common stock. And stock is issued at par value plus whatever excess of par value you had. So we can actually just take the whole 120 million, that's 120,000, I'm going to put the commas here so you can see, oops, plus 3 zeros. So 120 million divided by this 4 million shares, because that's how many shares of common stock we issued. Oops. It gives us $30 a share. I mean, we could just say, we could drop all the zeros and take 120 divided by 4. And we come up with $30 a share as well. You can drop zeros, and I'm used to doing that, so I'm trying not to do that here so you understand. So that's $30 per share it was issued at. $5 went to par value and $25 went to additional paid in capital. If retained earnings at the beginning of the period was $45 million and net income during the year was $9,907,500, how much was paid in dividends? Oh, what you have to remember here is you know how to calculate this stuff. So beginning retained earnings plus net income, oops, and I can't do that. I have to do this. Minus dividends. So equals ending retained earnings. We already knew this because we've been doing this all semester. What did we have in beginning retained earnings? We added our net income, we subtracted our dividends, and we get our ending retained earnings. So let's just put in the numbers we know. It says retained earnings at the beginning of the period was 45 million. $45 million. Net income during the year was $9,907,500. They gave us that number. What we don't know is dividends. Our ending retained earnings, if we look over here, is 53 million. 53,000 plus 3 zeros. So now we have something we can calculate. We can say 45 million plus 990,700 minus X equals ending retained earnings. And then you can just solve for X on that. What you'll get if you solve for X is 1,907,500. Okay. If treasury stock was purchased at $20 a share, how many shares were purchased? And if you look down here at treasury stock, it's a negative number because it's a contra equity account. So if we have 3,700 in here, plus 3 zeros, how many, and we paid $20 a share, how many shares is that? So 3,700,000, right? Divided by $20 a share gives us 185,000 shares. How much was the dividend per share? So the formula for that is dividends divided by outstanding shares. Well, we know our dividends are 1,907,000. How much are our outstanding shares? This is where issued, authorized, issued, and outstanding becomes important. This is how many shares were issued. They always remain issued. Even when we repurchase them, we just show them as a negative. They don't become unissued. So of this 4 million shares, they're not all still out there. We have repurchased 185,000 of those. So what we want to take here is the 1 million, let me just reference that cell, 1,907,500, and we want to divide that by the 4 million minus the 185,000. And that gives us dividend per share of 50 cents. If you ever want to see what's included in a formula, so you see how the formula is shown up here, you can just hit F2 and it'll actually highlight the cells that are included in the formula. So you don't have to figure out which cell is R10 and which cell is R6. If you highlight them, they pop up and you can see them. Okay, good luck with this chapter. You're on the downhill stretch. Chapter 11 is not nearly as hard, and chapter 12 is downright easy. So hang in there. You're almost there. Here's a chance to pump your points and raise your grade for the rest of the semester. If you need anything, let me know. Thanks.